All right. Good morning, everybody. So it looks like chip makers are getting whacked this morning, and we got a couple of earnings, McDonald's and a few others. UPS. I seen an article yesterday that Goldman Sachs is anticipating the Fed is going to keep their word, which is what the argument is right now on the street. How the Fed is trapped and it needs to anticipate a pivot soon, but the Fed can't talk about a pivot because the market will explode higher. So a lot of the bond trading and the positioning into the FOMC is based on the idea that the Fed is lying because it's, not going to want to see the market explode higher. Goldman Sachs came out and said, we're going to just take them at their word and that they're going to continue to raise at 25 basis points at a time, and that their target is still going to be somewhere between 5 and 5.25. Well, currently we're sitting at 4.25 to 4.50. So, if we're still focused on the Fed's target rate of 5 to 5.25, then we're looking at 3 more rate hikes, 25 basis point rate hikes apiece, February, March, and May, each 25. That's Goldman's take. And that's so far what is being priced in, except for May. May has the pivot right now, and Goldman is disagreeing with that. Doesn't mean that they're right or they're wrong, right? They, there's the meme right now, don't fight the Fed. And if the Fed said they're not going to pivot and their target is somewhere between 5 and 5.25, then that's what we should anticipate. Crazy, right? Take them at their word? I don't know. Kind of light on the Econ today, and it will mostly be done through the morning. So once we're through the morning, we're pretty much through with Econ. Asia had a little bit of a continuation and are nearly back down to the lows on the previous week. I guess we're already past that. And Europe is still trying to come up off of those lows this morning. We got an angled trend line that we tagged this morning, kind of getting a bump back up. That was a significant move to the downside. This could just be a little bit of a knee jerk before continuing lower, especially since there's nothing really heavy on the financials, on the Econ. We do have an additional auction today at 11 o'clock. and farm prices at 3. You know, it's going to be power hour already, so you should be, cautious since it is power hour. I don't think farm prices warrant more than your original caution due to the fact that it's power hour. I wouldn't consider this to be too impactful. That doesn't mean that it doesn't matter. It absolutely matters. I just don't see that it has enough weight to really rock the boat, especially in an FOMC week. So once we get onto the other side of lunch, your 0-day should be good to go into the afternoon. Normal volume today, nothing that stands out in the overnight for cumulative volume. Just take that off. We don't need it now. And the continuation of the price swings. We'll use this R tool. It's the regression line. Just start at the top. It doesn't need much help from you. Just move your mouse in the right direction and it'll snap to. The swings are clearly defined. So what we're looking for is the next swing, right? We're looking for this to top out, give us a lower high than the previous high, and roll, continue to move to the downside, giving us a new low, lower than the previous low. At some point, we're going to begin basing, and we will get an equal low or maybe a higher low, and that'll be the start of a turning, but we're not turning yet. Now, we talked about yesterday how in the FOMC week, we have the anticipation that we're not really going to go very far until, the FOMC. So when we got to the low yesterday, and we tagged this week, this is the 3rd week of January. That was a nice reversal yesterday. Right off of the lows. It didn't keep. And I'm looking at it in the SPX. It didn't keep, right? But it held a little bit. Going into the overnight for a little bit. That was pretty much the move on a lot of names yesterday that actually bounced back better than SPY did. So right now we've got an ADR of 1.5. As we've discussed before, FOMC is a volatility suppressor. So as we get closer to the FOMC date, we expect the distance from daily close to daily close to get smaller. And that equates to a lower ADR. We don't have a market maker move this morning, at least not in the ES. We had a very narrow IB last night, an initial balance, but we've expanded beyond that. And when we got halfway through the kill zone, we had a significant move event. I know it doesn't seem like much, but that was a heck of a move. It wasn't reflected in US dollar China or in US dollar Japan, but we can see it in the dollar really clear. The VIX, the VIX, recognized that something happened, but that was about all the VIX gave us on that. We're below the daily pivot, which gives us an MDP. We haven't touched it at all, so it's a missed daily pivot, MDP. There is a trade strategy that goes along with that. I don't trade the strategy. It's not mine. I didn't make it. But within the strategy itself, it actually provides ways to analyze the market by recognizing price and its interaction with that pivot point. So while I don't trade the MDP, I learned the strategy and I use it as a part of my analysis when I'm looking at where price is and where that pivot point is. So it's worth looking into if you haven't heard me talk about it before or mention it. All you have to do is go Google it or go to YouTube and search for it. You'll find the creator of it and more than enough documentation to help you understand what it is. So this morning, we're underneath the weekly pivot point. We're underneath the daily pivot point. We had that nice 2-bar reversal a little earlier back to VWAP. And the reversal came right on the ADR half. Imagine that. These pivot points matter. Open, high, low, and close, as demonstrated yesterday when we stopped right at a previous week's high and found support. Yesterday during the day, we kept running up into the 5-minute open range on a lot of names, and we would stop right at where we opened. Again and again, we kept hitting that spot, pausing. So there's some of the best pivot points that you can use. So we talked about this zone yesterday. And we discussed this trend line. Doesn't have to be perfect. It's more of a visual than anything else. Now we've wicked through it by itself. That doesn't mean that it's broken. We could, wick through it and come back in again. The rate of change is a little steep, so you could anticipate a TRB this morning, trend line breakover back up. It's not likely, but after moving with a rate of change like this, you could get a breakover and at least a retest of the 50% mark. So from this low that we made back up to the high pivot, we'd be focused on a retrace back up to the 50% mark. So if we do start to rally this morning, 40.57 would be the line in the sand. If you're bearish, you're not going to want to see it get beyond that level. That would be the worst case scenario, is that it gets even up to that level, let alone beyond it. So after a little bit of a move to the upside, we still have the expectation of completing this low. That would be 39.70. Yeah, 39.70. That would be for today, right? Today and maybe into tomorrow before the FOMC itself. We still have to get through the FOMC. All right, 10-day, 30-minute volume profile. We still don't have a classic shape, but we are now below the point of control that we talked about yesterday. And 39.85-ish is the last area where price might find a little bit of help in a move to the downside. So if we break our current low, that 40.11 low, there's really not a whole lot to catch it or slow it down. And we have an air pocket of risk down to 3,900. Now, you would anticipate a move like that having a force behind it, right? A catalyst that lights the fuse. But yeah, it could be anything. You know, it doesn't necessarily have to be Econ. It could just be some news that the market didn't like. Without something to move us like that, it's kind of hard to see how we're going to expand beyond this 39.85 minor. And we still have the expectation that the range is defined into the FOMC. We have another VPOC now over our head. So if we make a move to the upside, 40.55 is where there is a virgin point of control, VPOC. And looking at how far away from the 10-period moving average we are, we're there, right? We're 0.08, less than 0.1% away from the 10-day moving average. So we're going to be interacting with that 10 today. Generally, we would be looking at this as maybe, you know, an opportunity for a continuation, but it hasn't been that clean, and we no longer trust the 10 at its location. You see back here where we had a well-defined run, and the 10 was respected through that run, or back here where we had a well-defined run and we kept our distance from the 10 with the continuation of price action. But when you get into something like what we're in here, where we've crossed through the 10 multiple times, or back here, it has no respect at that point, right? We would have to define the run and get away from it. So we interacted with it yesterday, managed to get back above it. Very likely we're going to interact with it again today. If you want to see that on your chart on Thinkorswim, look at the daily moving average on an intraday chart. Type in the word daily and load the daily SMA. Thinkorswim doesn't have a daily EMA. This is a custom one that I made because I wanted the EMA rather than the SMA. You can get it in the Thinkorswim workbook. As so far, McDonald's really hasn't done much after its earnings this morning. I was going to correct that bar. Just get rid of it. There we go. A little cleaner. And UPS also hasn't really done much this morning. It was earnings, but it was also news out of the White House. The White House is going to be going after these energy companies that performed share buybacks with the proceeds instead of trying to assist people with the higher costs. Some kind of feel good, huggy dictatorship post came out yesterday on that. Yeah, socialism at its finest. You have money and somebody else doesn't, so you're bad. We're going to have to go after you for that. Oh my goodness. So Exxon Mobil, you know, it fits that category. It wasn't the only one. They had an article that came out that listed a number of them. The article, you could find it on Bloomberg. It was also on Seeking Alpha. You know, it should be pretty easy to find. And it was on Twitter yesterday where the White House had mentioned a number of companies by name. Overall, ExxonMobil continues to do really good. If we take it back over, you know, a 20-year time span, we've got this multi-decade breakout in play right now that is doing really good, all things considered. And we are topping out at a level hit back in 2008. So, you know, you got to kind of have a little bit of anticipation of a pullback. The same thing as when we got into this level and we pulled back. You see those long wicks, a lot of digestion there. Probably some buyers from way back here taking profit or getting out, right? Hitting the escape hatch after years of just bag holding and suffering through the trash. So, yeah, it'd be good to see this finally break the 08 high. They say, you know, it's going to be the decade of energy. It certainly looks pretty good so far. There is a strategy on 52-week highs. And there's a lot of 52-week highs. So that, it's not like some unique thing. But in the book, Hit and Run Trading, they talk about a 52-week high strategy that sets the entry price 2 pennies higher than the last high made. After the level has been broken and price comes back down and gets ready to run back up again. That kind of fits the bill now, right? We've got the high set. We broke the previous high on a more normalized chart, like a 1 or 2 year chart. Got the pullback. We'd be looking for a retest and a breakout. There's really not a whole lot going on out there because we have the FOMC tomorrow. Gold and silver are down. KWEB is down. Emerging markets are down. Semiconductors are getting a little bit of a gut punch. Everything is leaning negative, which makes sense because we'd had a nice run up into FOMC, kind of, buy the rumor, sell the news. In the airlines, there's this inverse head and shoulders that is playing out on the daily. We had that 50 moving average cross. So we're above all the mess, and we're testing the 3-day. So if that 3-day holds, we could see a continuation of the trend. Otherwise, we are heavily extended beyond the 10-period moving average, and we have an expectation of coming back to revisit that at around $19, which would be the shoulder, or what they call the neckline break. A good head and shoulders should not pull back all the way to the neckline, by the way. So if it does that, we're going to completely discount this head and shoulders. I guess it's on a weekly, not a daily. Right now we're looking at UAL, and this January 16 weekly close candle is the one in control. So if it can find some support around 47, we'll look to retest the high of that candle again at 52.5. There's a lot of liquidity still up there, and it doesn't look like we're done with it yet. So until we get through 52.5 and get above it, you have to have an expectation that every time we get there, there's a large pool of liquidity that we're just trying to absorb. And so far, we're not done. All right, so that move in the dollar is pretty impressive. But we still got to get above 103 for kind of a change in perspective within the ES or the S&P. So if the dollar can get above 103, we're going to be looking to get down below 4,000 in the ES. That 4011, we kind of overshot the cog line a little bit, but nice 2-bar reversal. It held. We've got 4031 overhead we still got to get through, but it's going to be a big focus on the dollar. US dollar Japan is still something that you want to watch, but it's more about late February into early March where we got concerns. So US dollar Japan, not expected to really rattle things. It's more about the dollar itself, or the Dixie, the dollar index. Bonds woke up late. We were mostly range bound yesterday. That makes multiple days now in a row where we're just not doing anything. $107.5 in TLT is kind of the line to get through. The zone is pretty clear between 108.5 and 106. All right, some of the most beat down moves we've seen this morning that kind of continues from yesterday. Nvidia is one of those. Little pop up to close this gap. And Apple working on getting that gap closed too. So I was taking a look at this continuation in Facebook. You got to kind of, be careful. We got earnings tomorrow. But this might be worth taking a look at on the other side of earnings. Right now, they're likely just running it into earnings. It has no implications based on how it's moving before earnings on how the earnings are going to be, right? So don't take that into account and think, oh, well, look, they've been buying it up. Maybe their earnings will be good. That has no bearing on it. But what I would be focused on with Meta is kind of gaming it out and thinking about how the earnings is going to work out here. Earnings could be a dud, like they kind of were back here. They weren't great. They just weren't bad. So the market didn't sell off, but it didn't really, spike and run to the moon. Here, earnings were kind of bad. So, I had that sharp, hard sell-off, but within a week it stabilized, and it's been, mostly holding above that 10 since then. And now here we are. So we've had two situations, two scenarios of what it would look like for a mildly negative or a mildly positive outcome. But one thing that I'm really focused on is this gap here. So what happens when you get a dud earnings and earnings where nothing really happened, which usually comes after a really big miss and a really big move? everybody starts looking for the next earnings to also be a really big move. And when it didn't happen, then they kind of relax a little bit. They don't hunt for it, and then we get another one. So we've had a reasonably decent move compared to this little minor gap from back here. It has the potential for a big move to catch people offsides on that earnings. So you could play some YOLOs. That's one way to go. But you could also just game it out. What if it's positive? Where would Facebook go over, say, the next month? For 35 cents, you could buy a $2.50 wide debit spread. If you're right, and we make a reasonably decent move to the upside over the next, say, 3 weeks after earnings, this has the potential to make, somewhere between $1.50 to $1.75, kind of rounding it down a little, because we wouldn't want max profit, right? We're just looking for a reasonably sharp move in the right direction towards the 170 area. If it started moving in that direction quickly, this spread would begin to monetize, and you could look to take your profits off. You're risking $34, but you could cut that number down and say risk 2/3 of that as your max loss. So a really low risk value compared to what you could make. And then kind of game it out. If you don't like that and you think it's going to be bearish, then take the other side, but still go out quite a ways. Looking at the 135's got a lot of open interest, reasonably decent liquidity, all things considered. We were $2.50 down here, so I guess it would make sense to go at least $2.50 up here. Something like 130, 132. I like that 133 better, but costs will start to get into you if you get that far. It's around $70. Cost-wise, it looks like you're just better off going long, but that alone is not a really good reason to pick your trade, right? Just based on, well, it's the cheaper trade, so I'll go long. Nah, not necessarily. Now you could wait for it to report and then do that. That it's not really going to hurt things in the long run. Just take your spread out a little bit farther in time. The idea would be, if earnings are really bad, we're likely going to revisit the $100 area, maybe a little lower, right? Retest those lows of 90. Facebook's got a history of really hard gap down earnings reaction. So, you could go all the way out to $90 on the put side, with the expectation that if we're looking at a seriously bad earnings, it could easily dump down that far. And we're not the only ones that think so, because look at all this open interest sitting at the $100 area. $5 wide spread for 12 cents. $10 wide spread for 28 cents. So you could wait for it to report and then do that. If it's negative, just buy your spread down around $100 or $90. And if it's positive, try to aim, higher than the 160 area. I would go for at least 170, if not 180. And again, it's not that we think price is actually going to go to 180 or 170. It's more the idea of if it moves in that direction fast enough, that spread will monetize and you can get out of it with, 35 to 55% of your max profit. The only issue is when we have earnings, if it's good or bad, we're going to see a volatility crush. And your long spread is going to take a gut punch from the volatility crush. And then if we do go up, say earnings is good and the market rallies, you're going to take even more of a volatility crush, right? So like back here, earnings was announced, so volatility dropped, price recovered, began to move back up. And as price moved up, volatility continued to move even lower. It's not going to cripple your trade. It would still be based on the idea that if price is moving fast enough in the right direction, your spread will monetize. I keep coming back to those airlines. They had a nice run into the start of the year. They were heavily shorted. There was a lot of short covering. Not looking at this as like, ooh, airlines are ready to be bought. Not by me. You can see this through the trash here, this yellow line. We hit that the other day, or a few weeks ago, I should say. It's a weekly chart that we're on. Hit that level, pull back. If this is just a short covering rally, then the expectation is that we're done with it and we're going to dump. Now, I mentioned that, but we had the same kind of a short covering rally back in 2001, and it lasted for 3 months. So, and then we double topped. But after that nice little burst, if this is a part of all the rest that are going to be starting to fade now that the short covering seems to be slowing down or ending, then that would be a nice short back down again. It's worth keeping an eye on or even lining up for an opportunity. We're through the earnings and they weren't horrible, or it would have dumped, but they weren't great because we didn't rally. So breaking below 15.7 would be the start of a continuation to the downside. It would be last week's low that we're focused on, which happens to also be a major level. These are cheap enough. I don't see a reason to do a spread. Something to keep in mind when you're looking at really cheap companies like this. It's a $16 company. You can just straight up buy the option for 20 or 30 cents. No reason to do a spread here. You won't really gain any benefit from that, right? The spread is designed to limit your risk and reduce your risk. And that makes sense when you're looking at options that are, $1,000, $2,000 a piece. But in this situation, just buy the option. Unless you're going to do a credit spread, right? That'd be the one that has some benefit to it, rather than trading a naked option. So with that in mind, buying the 16.5 put, it'd be the in the money put, or the 16, I guess, either one of those. 16 would be a little cheaper in the money. I wouldn't go any deeper than 18, the 18 strike put. You run out of liquidity at that point. And I think you just start getting into some trash. All right, we're still looking for nat gas to stabilize along these lows, and it still, so far, continues to prove that it's not done falling yet. So 8.9 is still the line that we want to focus on. When we get there, we're going to expect to see some stability, a little bit of price structure, some basing, and hopefully, like it was doing at 1028, we'll see a lot of that. And instead of actually dumping down below it, we might start to see it turn around and head back the other direction. It's easy to look at this and think that it owes us a reversal and a move back up, but that it really isn't true. It doesn't owe us anything. It could just continue to go lower. It hasn't even come back up to retest the 10 yet. So, it's not done falling. It set a new low yesterday. It's not showing any kind of pause or reversal in this move lower. I wouldn't go long yet. No reason to jump the gun on this one. Let it prove it and turn around first. Or at the very least, let it just stop falling. And so far, it hasn't proven that it wants to, that it's done yet. Solar is in a bit of a wedge. It seems like it's running out of time, right? We don't normally see price get all the way into the end of the wedge. Somewhere around 70% or so is where it generally gets out of the wedge. So we're kind of getting there in solar. I am on a weekly, so there's an expectation, that at least a month before we reach the edge, but it's worth keeping your eye on. This thing has the habit of making some big moves fast. Energy took a little bit of a pullback, but, right, there's always that but. Look at the the low of last week. It's going to be the line in the sand for us right now. And if you look at these lows over the last month, it's just had buyers sitting down there. So we need to see if they're done. If we make this move to the downside, is there anybody left? And if not, then we're likely to retest around that 82. But it has to get there first. Right, it has to get to the low of last week and start that breakdown. Now, if you're running a short-term trend line, we're definitely below that. Or if you was to even, run it even shorter. So one worth watching, inside week breakout on XLE to the downside. We're looking at revisiting 82. So be cautious just because it starts the breakdown. I wouldn't immediately short it because we've got another week right behind it, right? Within like 50 cents. So you could start with, say, a 2 lot and then scale in if we get past that other low. Think of the strat and that where the stops would be located, right? For anybody who's long. All right, energy aside, we've still got finance that has been making some pretty wild moves. They started earnings season and it's been kind of a mixed bag. We've seen some big moves in finance yesterday. It didn't really bleed over into XLF as much as I would have expected. Last week's green candle that we're sitting inside of is the line in the sand right now. A break above that, and we should have a nice continuation up off of this low from last October, right? So we've had our higher high and our higher low. We're looking now for our next higher high. That needs to happen now, right? If this continues to sell off, then we're going to have a lower high here. And that's not cool. So this needs to complete this week, needs to hold above the green candle of last week, the 50% mark. That would be 35.86. It needs to stay above that level and then continue to the upside. The continuation doesn't have to happen this week. It just can't close below. Otherwise, this becomes our lower high. All right, American Express yesterday tried to continue that earnings move and failed miserably. The candle is dark green, solid green, I should say, because it closed lower than it opened, but higher than the previous day's close. So it was still a green candle, but it's not a hollow green. It's a solid green because of that closing lower than it opened part. So this failed to complete the inside day breakout and managed to close really close to where we closed the day before. The expectation is that this could become an island, and then we would be looking for it to gap back down, and this would all be an island reversal. It's not there yet. We don't even have an island yet. So we're going to be looking for a few days where it stays inside of this earnings candle. And after basing up there for a little bit, we'll then expect that gap down. Of course, the whole thing is negated if it jumps and breaks above the high that's been set around 178. That wedge, though, is really clear on the weekly, and it's kind of a great example of what we're looking for in those other names. Whether it's going to play out or not, we'll have to give it time. All right, everybody, tomorrow, FOMC, it's the thing, right? It's the one thing we're all focused on. Really kind of consider what you're holding and ask yourself, are you comfortable with a 6% move in SPY over the next 3 days between now and Friday? Consider, what a 6% move would look like. That would get us up to around 42.5, right around in there. I'm kind of overshooting, but so 42.5 to the upside, and around 37, call it 38 to the downside. Just some sloppy numbers, but they'll work, right? That's the kind of move that's on the table. Between now and Friday, we could see the top of this box or the bottom of this box. And you got to kind of think how that's going to affect everything else that you're holding. It doesn't matter, if you've got Google or Amazon or SPY. You can beta away your holdings and see what the impact of a move in SPY would look like, because you would turn all of your betas into SPY betas. That way you're not comparing apples and pineapples. You're comparing apples to apples, and see what it would really look like if the S&P moved and what your portfolio would do. So it's certainly something to consider. But think about after FOMC, right? If it's good, what's your game plan? We still got a month after this FOMC before we have another one. So we can't get too comfortable. But in that month, we can make some good plays. So if it's bad, what are you going to focus on? Which names? And if it's good, again, what are you going to focus on? Which names? Not just the names themselves, but which sector, which industry, which sub-industry. Right? So if it's bad and we see equities go down, a lot of these still overpriced tech go down. What are we going to rotate back into utilities and energy and services? And if it's good, we gonna continue to dump services and energy and utilities and staples and focus more on these semiconductors and tech plays? That's what you want to consider. That way you're not just responding to what happened at FOMC, but you're preparing for what could happen at FOMC. Everybody have a good morning. Be safe. Be careful. I will see you all tomorrow.